Let's look at two couples. Both buy a house, and both take out an identical $455,000 mortgage. Couple A takes the traditional path. They shop around, negotiate hard with different lenders, and secure the lowest interest rate available to them, 4.29%. Couple B takes a different approach. They accept a structurally different loan at a higher interest rate of 4.49%. Even with a higher rate, Couple B pays off their house 9 years faster, spending nearly $100,000 less. We obsess over rates, ignoring loan structure. The only number dictating the money paid to the bank is the total cost of credit. To stop leaking hundreds of thousands of dollars in excess interest, you have to reverse engineer the profit mechanisms banks use and apply those exact rules in your favor. Defeating the system requires looking past the illusion of the headline rate to change the actual flow of your money. The first structural flaw in most personal finances is feeding the bank's primary profit engine, the spread. Banks take your savings, paying you less than 1%, and lend it out at 5% for mortgages, pocketing the difference. The fix? Dump that idle cash directly into your mortgage principal. You instantly sever that 4% bank margin. Most people hesitate to do this because they fear being cash poor. If an emergency happens, you need access to funds immediately. To solve this, you replace the cash buffer with a dedicated line of credit linked to your home. It sits there securely, usually at prime plus a half, and costs you absolutely nothing until you actually draw from it. By replacing a stagnant pile of cash with a zero-cost credit line, your emergency fund starts paying down your debt. You reduce your cost of credit by thousands of dollars a year without losing financial security. Next, we have to look at the anatomy of your monthly payment. On a standard 30-year mortgage, only about 25% of your payment actually hits your principal. This chart breaks down exactly where your money goes every 30 days. That massive remaining 75% is lost entirely to the bank as interest. To invert that ratio, you need a specific loan structure where your line of credit is directly integrated with your mortgage, functioning as your everyday checking account. Instead of routing your paycheck to a standard bank account, you deposit your household income directly into this linked credit line, and you pay your normal monthly expenses right out of it. Because the accounts are tied together, every dollar left over at the end of the month is automatically swept into the mortgage principal. This daily maneuver systematically forces your principal-to-payment ratio up from 25 to 55% or more. Automating your cash flow through this linked structure means your everyday spending habits now work to shorten your loan's life instead of just covering the interest. This logic applies to external debts, like car loans or credit cards. The traditional trap is folding these into a standard mortgage. Your monthly rate drops, but the bank resets your payoff timeline to 25 or 30 years. Artificially stretching that timeline means you pay significantly more total interest. The bank wins because the overall cost of credit increases, despite the lower rate. To consolidate properly, you use that same integrated line of credit structure we just built, but you organize the outside debts into separate, trackable subaccounts. You secure the lower interest rate within the subaccount, but instead of enjoying a lower monthly bill, you funnel what you used to pay on the old loans directly into the principal. This forces a much shorter payoff timeline. True debt consolidation requires capturing the bank's lower rate while strictly preventing them from extending the clock on your debt. When you stop optimizing for the interest rate and manage the total dollars out the door, the true reward is finally buying back a decade of your life and reclaiming hundreds of thousands of dollars. You dismantle the bank's machinery by executing 3 specific pillars. Eliminate the spread on your savings, maximize your principal-to-payment ratio, and consolidate debt without extending timelines. Executing this strategy requires moving away from chasing a marginally lower rate to focus on your total cost of credit. Conventional financial institutions rely on borrowers remaining in the dark about these mechanics. If you want to master these rules for yourself, read the #1 Amazon bestseller, From Debt to Zero. And to see what this looks like for your specific situation, calculate your personal cost of credit and apply for a 30-day structural implementation at mortgageslab.ca. The tools to dismantle the bank's profit machine exist for anyone willing to stop playing by the bank's rules.